Okay, picture this. It's August 24th, 2026, and a massive headline just dropped. Boeing is securing a gargantuan defense contract for its F-15 Eagle Crest program. Now, on the surface, this sounds like the ultimate win for an iconic American manufacturer, right? We're diving right into this explainer today because this situation is actually a fascinating financial mystery. $131.23 billion. I mean, that is just a staggering amount of money. When a headline flashes a number that astronomical, it completely dominates the news cycle, for sure. It immediately sets up this expectation that all of Boeing's recent financial and operational troubles might finally just be a thing of the past. It looks like a golden ticket, the kind of money that makes your operational problems disappear overnight. But here's the twist. Right next to that massive new contract is this number. Boeing is carrying a crippling $45.9 billion in consolidated debt. So let's really think about this. How in the world can a company win a contract this huge, have what looks like an endless pipeline of demand, and still be carrying debt that massive? It's a fundamental contradiction, and it's exactly what we need to figure out. And honestly, it gets even wilder when you look at the active bleed. In Q2 of 2026, Boeing posted a net loss of $428 million. The commercial airplanes division, all by itself, lost $322 million. Now, the really fascinating and frankly brutal reality here is this. Despite bringing in over $24 billion in revenue for the quarter, which was actually up 8% year over year, they are still actively losing hundreds of millions of dollars. The top-line growth is totally there, but the bottom-line profit, it's just entirely missing. So, to understand why a $131 billion contract doesn't instantly fix a $428 million quarterly loss, we've got to peel back the onion on that fleshy headline. This contract is an IDIQ. That stands for Indefinite Delivery, Indefinite Quantity. The absolute crucial takeaway here is that this $131 billion is stretched out potentially all the way until August 2037. It's a maximum potential ceiling, guys, not guaranteed immediate revenue. The government is essentially saying they might order up to this amount over the next decade. It's a tremendous opportunity, absolutely, but it is not a giant check they can just go cash at the bank today. And this perfectly illustrates why defense contracts alone just cannot single-handedly save Boeing. Look at how their business is actually split up. Defense, space, and security makes up 31% of their revenue, and global services is 23%. But that highly volatile commercial airplane segment, that still drives the bulk of their revenue at 46%. Defense contracts provide incredible government-backed stability, sure, but if the massive commercial side of the business is broken and operating at a loss, the entire engine just kind of sputters. Now, you might be wondering, well, don't they just need to find more airlines to buy their commercial planes? No way, literally, absolutely not. Just look at this number, $715 billion. That is Boeing's record-breaking total backlog, and it includes over 6,200 commercial airplanes. This proves, without a shadow of a doubt, that Boeing absolutely does not have a demand problem. The world desperately wants to buy what they are selling. But, when you actually dig into the fine print in their SEC filings, the realities of this backlog get a lot more sobering. Only 21% of this massive backlog is expected to actually convert to revenue through 2027, and 62% through 2030. The rest of it stretches deep into the next decade. Plus, this backlog is highly vulnerable to cancellations, supply chain hiccups, and production delays. This wealth literally takes years to realize, and it is entirely dependent on flawless, uninterrupted execution. Which brings us to arguably the most important question in aerospace right now. How many more aircraft must Boeing actually push out the door before the economics finally work? Because, as we've seen, they delivered 171 commercial aircraft in Q2, which is a 14% increase year over year, and yet the operating margins in that division are still sitting at negative 2.7%. Transitioning those top-line revenue illusions into actual bottom-line profits is their massive hurdle right now. The answer really lies in the brutal, unforgiving economics of building airplanes. This industry is defined by incredibly high fixed costs. Cost of goods sold, or COGS, is roughly 90% of Boeing's revenue. And their SG&A, selling, general, and administrative expenses, eat up another 10 to 13% of sales. With massive fixed costs like this, think gigantic factories, highly specialized machinery, and a massive workforce. Any disruption at all, whether it's a labor strike, a regulatory pause, or a single part being delayed, instantly crushes their profitability. You have to constantly, smoothly feed that production machine just to absorb those costs. But hey, it's not all doom and gloom. There is a very real glimmer of hope in their operational recovery.
Check out their first half free cash flow. In 2025, Boeing burned through a painful $2.49 billion. But in 2026, that improved massively to a burn of just $823 million. In fact, Q2 alone actually saw positive free cash flow of $631 million. So that massive cash burn is slowing down significantly, showing us that an operational recovery really is underway, even if the full year hasn't totally crossed into the green just yet.
To really cut through the noise and get an objective look at where Boeing stands, we can turn to some fantastic academic equity research from the Krauss Fund at the University of Iowa's Tippie College of Business. They took a really hard look at the data to benchmark Boeing against its fiercest competitors. And man, this paints a clear picture of what healthy execution is supposed to look like in this industry. When we compare Boeing directly to Airbus in commercial aviation and Lockheed Martin in defense, the gap is glaring. Boeing's overall operating margin is sitting at just 2%, while Airbus and Lockheed are at 10% and 11%. Boeing's return on invested capital is actually negative 5%, compared to 16% and 18% for its peers. And remember that 90% COGS for Boeing we talked about? Yeah, Airbus and Lockheed operate with significantly leaner, highly efficient cost structures that let them weather these kinds of storms so much better. All right, so what does all this mean for the future? Let's talk about the bear case first. The risks that could easily derail Boeing's multi-year recovery are huge. You've got those high fixed costs combined with slower production cycles. Then there's the inconsistent execution, things like union strikes and quality control issues that literally halt assembly lines. You've also got to factor in geopolitical risks affecting global markets, plus a persistent regulatory overhang and serious safety scrutiny from the FAA. But flip that coin, and the bull case is actually incredibly powerful. If new leadership like CEO Kelly Ortberg can pull off the monumental task of driving operational normalization and just easing those internal disruptions, the operating leverage kicks in fast. We'd see accelerating backlog conversion, like those massive Alaska Airlines orders turning stagnant inventory into actual recognized revenue. That leads straight to free cash flow recovery and debt reduction, all backed up by sustained global travel and military demand. If they can literally just normalize production, Boeing transforms right back into a massive cash-generating machine. Synthesizing all this data leads to a pretty clear, neutral investment verdict from the research: watch or hold. And crucially, the dividend yield right now is literally 0%. So for income investors looking for a steady payout, you should probably avoid this entirely. For conservative value investors, that massive debt and negative earnings are just too risky right now. Speculative investors really just need to patiently wait and watch for execution and margins to sustainably improve before making a move. Look, if you take only one thing away from this entire explainer, remember this core takeaway. Boeing doesn't lack customers, it lacks execution. All the flashy $131 billion defense contracts and record-breaking $715 billion commercial backlogs in the world mean absolutely nothing if you cannot actually manufacture the product efficiently, safely, and profitably. So I'm going to leave you with this one big, provocative thought to consider. Can Boeing finally manufacture its massive demand into sustainable profits? Or will its ongoing execution failures turn a $715 billion backlog into a colossal value trap? The answer to that question isn't going to be found in flashy headlines, but right there on the assembly line. Thanks so much for joining me for this explainer, and definitely keep your eyes on those margins.